All right, continuing on to lecture 6. Once again, we are using the iPad format of presenting the information since there's a lot of math involved and I want to be able to annotate a lot of these slides. So last week we talked about the dividend discount model. So it is a method for which we could value equities using a present value of the expected future dividends, and we bring it back to the present time. This week, we're going to expand on that concept here in topic 6. We're going to be talking about dividend payout policy and the imputation tax system. So imputation tax system is something unique to Australia and New Zealand, and you'll be able to go through it and see what it's like. So the first thing we're going to be talking about is the dividend policy and the dividend discount model, so expanding on last week's material. Then we're going to be talking about Linter's argument and how executives should set dividend policies. So we're going to go through some mathematical calculations of how, in some instances, an increase in dividend will lead to an increase in shareholder wealth. However, sometimes a decrease in dividend will actually lead to an increase in shareholder wealth. So we will go through and see how these are certain examples where such a situation could come into play, where increases in dividends or decreases in dividends would actually affect the shareholder's wealth. This is the whole idea of if you have investments in capital projects with higher returns than the equity discount rates, then you would have a net increase in shareholder wealth if you retain free cash flow. Whereas if you have a lower reinvestment returns on existing investments, then you would actually increase shareholder wealth if you pay dividends out, if you pay free cash flow out as dividends. So this is the argument, and we'll also go through some mathematical calculations. Then we have Madigliani and Miller's dividends irrelevance arguments. Madigliani and Miller, so I'm just going to say M&M going forward, it's a mouthful. Just the idea that if three conditions are met, then dividends are actually irrelevant to shareholder wealth. However, as we know, we do not live in a perfect environment, so the three conditions are not actually met. Then we talk about how dividend policy affects shareholder wealth, really related to these two concepts here. And last, we're going to talk about the imputation tax system about franking credits. So first of all, dividends, as we previously have talked about in the DDM model, have basically three main types. The most irrelevant type to our discussion here are share dividends. Share dividends are basically when you get additional shares for each existing member of currently, if you're a current shareholder, you get additional shares. So this is similar to a stock split in that most of these times, these are related to poison pills and related to self-defense strategies to prevent hostile takeover rather than rewarding shareholder or to maximize shareholder value. What's more relevant here are regular dividends and special dividends. So here in Australia, we usually pay dividends biannually, so twice yearly here in Australia, rather than the quarterly payments of dividends there in the USA. Here, biannual dividend payments, we have a half-year dividend and then we have a final year dividend. That is usually the structure that we have here in Australia. Then from time to time, if we have surprisingly good results, then we will reward shareholders by giving additional one-off large dividends to shareholders. So dividends are reported in three equivalent ways, and if you are given one method, you are able to calculate between the three given the information needed. So first of all, dividend per share. So this is we taking the total dividend payout and we divide it by the shares outstanding. And then we could get the dividend per share. Second is the dividend yield. So we take the dividend and we divide by share price. So we take the dividend per share and we divide by the share price. Lastly, we have a dividend payout ratio. So it is simply dividend per share divided by EPS. Or if we multiply shares outstanding by both sides, we will get total earnings and total dividend payout ratio. Total dividend payouts. So these are three equivalent ways of presenting the same amount of information, and just be able to move between the three if you are given the relevant information. So here's the technical how dividends are actually paid out. So first of all, there's a declaration date. At declaration date, management goes out to the public markets, goes out to the ASX and says, hey, we are going to pay this much dividends if you own the shares at a certain date. So you're going to say, oh, we're going to pay 50 cents of dividends if you own certain by 1st of Jan 2025, for example. So this is the declaration day where the firm announces the next dividend, as well as the record and payment date. The ex-dividend date is the first day where shares are traded without the right to receive the dividends. So if you own any shares after the ex-dividend date, then you have no right to receive the dividends. If you own shares on or before the ex-dividend date, if you own shares before the ex-dividend date, you own the right, or you have the right to receive the declared dividend. The record date is where the shareholders are recorded to receive the dividend. This is to see who is eligible to receive. And the payment date is when the dividend is paid. So this is the sort of technical actual structure of how dividends are paid out. Then we have the dividend policy. So once again, we talked about in the dividend discount model how regular dividends are expected. Regular dividends as in a constant dividend, over time, or a constant growth dividend over time. Okay, remember G and how G is accounted for when we calculate the DDM. So dividends refer to the decisions by corporations to pay out net profits as dividends, or alternatively to reinvest or retain the profits. It provides a framework for the distribution of earnings back to investors, thereby offering them a return on their investment. Some common categories of dividend policies are the regular dividend policy. This is the most what is used when we are using DDM. Company pays dividends at a constant rate, increasing at a constant rate, or stable or decreasing at a constant rate, in which cases we will be able to use the dividend discount model. The dividend payout ratio quantifies the dividend policy decisions by measuring the proportions of profits after tax paid out to the dividend as dividends. A stable dividend policy, a company aims to pay a stable or slowly increasing dividend over time, even if earnings are volatile. Residual dividend policy, so this is you pay out the remaining free cash flow after all capital expenditures are done. Hybrid is up to more management discretion. It's a mix of the different strategies here. Then we have no dividend policy. For example, Google. Right now, Alphabet, the parent company, does not pay any dividends. It reinvests all of its earnings and retains all of its cash flows. Regular dividend policy. So here is, for example, we take how do we calculate the regular dividends under a regular dividend policy? We take the dividends, we take the EPS, we multiply the dividend payout ratio, and we get the dividend. And we could calculate the growth by using the retained free cash flow, which is the dividend, which is 1 minus the dividend payout ratio multiplied by return on equity. If a firm is very big, you may need to do component-specific ROE and component-specific DPRs. So based on the dividend discount model we talked about last week, a firm may want to increase its share price. It may want to cut or increase the different dividends paid. For example, if the return on equity is much higher than the cost of equity, then you may want to retain the free cash flow to reinvest rather than pay it out to investors, because that will increase shareholder value. So the answer would depend on the profitability of the firm's investment. So whether to increase or decrease the payout would be dependent on whether the firm is good at converting equity into returns. So cutting the firm's dividend to increase the investment will raise the SARC price if and only if new investments have positive net present value. Otherwise, paying it out to shareholders will actually be more beneficial. So here's an example here. You can read that yourself. So here's an example. So another dividend policy here is the stable dividend policy, which could be modeled as a process of gradual adjustments towards a target payout ratio based on long-term sustainable earnings. So a target payout ratio is a goal that represents the proportion of earnings that the company intends to distribute or pay out to shareholders as dividends over the long run. So Lindner here developed a model to calculate the change in dividends. So the total change in dividends is expected earnings multiplied by target payout ratio minus previous dividends multiplied by adjustment factors. Constant versus stable dividend policy. Although constant dividend policy ratios is easy to use, such as the dividend discount model, is not commonly adopted in practice. The main reason is that it assumes dividends to fluctuate with earnings in the short term, and fluctuating and changes in the dividend payout could send mixed signals to the market. So it's much better if you have a stable dividend payout rather than having mixed dividend payouts as the earnings fluctuates. So although managers do not actively maintain a constant DPR, dividend payout ratio, is still an important metric that guides managers to making dividend decisions. Once again, DPR is taken into consideration when analyzing it in relation to the return on equity and growth prospects, and seeing if changing the dividend strategy would affect the shareholder value as a whole. So a stable dividend policy generally does not reflect short-term volatility in earnings. Even if the earnings are temporarily decreased over the short term, the company is still expected to gradually increase its dividend. So why would we still use a dividend discount model, even though there are certainly fluctuations in earnings that exist more than we will anticipate? Once again, is because it is a simple and cost-effective method to analyze a certain equity, and it provides an academically credible method for valuing equities. We are still thinking of discounting cash flows back to the present day, but rather than individually estimating cash flows out to the future, we could use a simple calculation of dividend at time 1 over cost of equity minus G. So this is a very, very simple back of the napkin calculation that could be used to quickly estimate the value of an equity. All right, so let's talk about dividend policy and shareholder wealth here. So Miller and Modigliani in 1961 came up with the idea that dividend policy actually has no impact on shareholder wealth. So and this is certainly a very controversial idea, because previously we talked about how when ROE is greater than the cost of equity, when ROE is greater than cost of equity, if we retain more, then shareholder value would increase because we retain more and we invest at a higher rate than our cost of equity. However, if cost of equity is less than return on equity, then increases in retention ratios would actually decrease shareholder value. So this is the idea that this situation is, we could prove it mathematically. If we go back to the previous examples, we have proven it mathematically that ROE and cost of equity really does affect the shareholder value. However, here in M&M, we are going into a sort of different hypothetical situation where dividend policy could actually be irrelevant. Now, what are the different assumptions? So the first assumption is that there is no transaction cost involving in issuing new shares, and there are no transaction costs in buying and selling. Once again, when Miller and Modigliani in 1961 came around, the cost of issuing shares and the cost of transactions are very significantly high. However, nowadays, even issuing additional shares, you would have to give investment banks around 5 to even 7 or 8% of the shares issued. So it's certainly very expensive. However, in M&M's dividend irrelevancy theory, there is no transaction cost. So the second one is all market participants have the same information. So this is the idea that people are informed in their information, and therefore they can make informed choices. Lastly, there's no personal or corporate taxes. That really throws a wrench in the whole M&M dividend irrelevancy theory. So what's the idea here? The idea here, okay, is that if a company wants to increase dividends, there are only two methods, okay? There are only two methods of increasing dividends. They can either cut back on investment on current projects, or they can issue new shares to finance current projects, okay? So a company is currently already paying dividends. If I want to up this dividend, there's only two methods. I could either cut back on investment. Okay, so cut back on investments, or I could issue new shares. By issuing new shares, I am selling off pieces of the company to new investors. Okay, so this is the idea that these are the only two ways you can increase dividends. Now, sort of like we could see a problem right off the bat. If we cut back on investment, then future growth will be affected. Future growth will decrease, and future earnings will be expected to decrease or slow down at the least. Now, if it slows down or decrease at the least, then what we will get is shareholder value that decreases. On the other hand, if we issue new shares, if we sell out pieces of the company, then the percentage of each share represents would also decrease. So therefore, shareholder value will decrease. So even though we increase dividends, which increases shareholder value in the short run, we actually decrease shareholder value by doing these two actions. So this is the sort of assumption of how you can increase dividends without it's either one of these two. So let's go through the mathematics here. So the conditions under which dividend policy is irrelevant here is that if a company cuts back on existing projects, its future cash flows, hence the share price, would fall. So the future cash flows will fall. And once again, what is the value of a share? The value of the share is simply the discount of future cash flows. Now, if we discount future cash flows and future cash flows have decreased because we have cut investment here on existing projects, then the value of the shares would fall. So if a company issues new shares, this is the second method for which we could increase our dividends. If a company issues new shares, then the existing value of the company will be spread across a greater number of shares. So if this company right here has 10 shares, and then we want to bring on additional investors, so we issue one new share. So now this company here has 11 shares, okay? So with the percentage that each person owns of the company has decreased. So this is the idea that if you issue new shares, the value of the shares decrease and therefore shareholder value falls. Either way, the increase in dividends will be offset by the decline in the price of shares, leaving shareholders no better or worse. So here's the idea. Here's an example. You could pause it and you could read it yourself. The second example is liquidating assets. Consider the implications of a corporation liquidating one of its projects in order to pay additional dividends. Now, when we value a company, this is the company. This is a company, let's say 100 mil. Okay, 100 mil. With 100 mil, you buy the entirety of the company, including its assets. Now, if I sell a piece of equipment worth 1 mil, this company is only worth 99 mil. So in a perfect, once again, we go back to the assumptions right here. In a perfect market scenario where the market has perfect information, we know that the company is now no longer worth 100 mil, but the company is now worth 99 mil because it has gotten rid of $1 million worth of equipment. Therefore, even if you pay out 1 mil in dividends, the net shareholder value is the same. Okay, it's 100 million because if you, it doesn't matter if you have 100 mil in a company or 99 mil in a company and 1 mil in dividends, it is the same effect. Given there's no taxes and no transaction costs. So consider the implications of a corporation liquidating one of its projects in order to pay additional dividends. The effects of this is depicted in the following diagram here. So here's an example of liquidating assets. An increase in the dividends is exactly offset by the fall in the value of the corporation, and the shareholder wealth is therefore unchanged. Issuing new shares, also the example here, we're bringing on, consider the implication of new shares. So bring on new investors, we are diluting current shareholders, and therefore the value of shareholder wealth decreases. Why dividend policy is irrelevant. So this is based on Eminem's idea. Our discussion regarding irrelevance of dividend policy was based on Eminem. And here is the three ideas. It is based on the three assumptions. Perfect information, no transaction costs, no taxes. This is a fairy tale world, unfortunately. Taxes do exist, unfortunately. So the Eminem theory does not work in the real world. However, it gives us some things to think about when managers are setting a dividend policy. So it should be clear that these assumptions are unlikely to be valid in the real world. In this week's tutorial question, we'll work on some situations here. All right, so the imputation tax system is something uniquely present in Australia and New Zealand. So that's the sort of depiction of Australia and New Zealand. It's a uniquely Aussie and Kiwi thing. It is very rare. So it is the idea that dividends are paid out from the company's earnings. Now, companies already pay taxes on the earnings, so individuals should not need to pay taxes again on the company's earnings. So this is the idea of removing double taxation on the corporate level and in the individual level. So this is the idea that rather than in the US where dividends are taxed twice, here in Australia and New Zealand, dividends are only taxed once at the corporate level, and the corporate payments on corporate taxes are then passed down as a franking credit to the individuals. So the classic tax system, as followed by the U.S., is companies pay tax on the corporate level on their income, and the shareholders pay their marginal income tax rates on all dividends paid out. So U.S. corporate tax rate may be 25%. And then when you get to the individual level, you may have to pay a 40%, 45% tax. So you get taxed basically twice. Whereas in Australia, there is a franking system, a franking credit system that you only have to pay taxes once at the corporate level. At the individual level or at the corporate level. So in the imputational tax system here in Australia and New Zealand, companies pay tax at the corporate level on their income. Dividends are paid out with franking credits representing the amount of company tax that has already been paid. And shareholders pay tax on their personal marginal tax rate on the sum of cash dividends and franking credits. So companies, so this is a company, it pays two things. It pays dividend and it pays franking credits. So franking credits is what the companies pays to the ATO, and it just passes it on to the individuals. So here's an example here. Let's look at a pause the video and read this example, and let's look at the example. So here's the classical U.S. system, and this is the Aussie system. So in the U.S. system, we have $10. Okay, $10 of company income. So the company pays 30% of taxes. So the company now has a net profit after tax of $7. This is the same thing as Australia. Australia company has $10 of taxable income. It pays 30%, so it pays $3 in taxes, in corporate taxes. Then both companies ends up with $7 of net profit after tax. Now, we pay all of this net profit after tax to shareholders, okay, 100% dividend payout ratio. So the U.S. Dividend payout ratio pays $7 to shareholders. So the shareholders have $7 of taxable income, okay, $7 of taxable income. And then we multiply a tax rate of 45%, and we get 3.15% of taxes payable. We subtract out a 7 from we subtract out 3.15 from $7, and then we get after tax value to the shareholders of $3.85. Now the Aussie system is a little different. Okay, the Aussie system is a little different. Rather than only calculating the individual taxes on the after tax value from the net profit after tax, we add back the corporate tax rate. Okay, so we add back the corporate tax rate to the individual. So we get 7 plus 3 equals 10. So we get 10 here for taxable income. And then once again, the same thing, we multiply by 45% tax rate as at the individual level. Then we subtract out the franking credit. So the imputation credit is the same thing as the franking credit, it's just a different name. So we subtract out the imputation credit, giving us a tax effect of only 4.5 minus 3, which is 1.5. Okay. Then we subtract 1.5 from 7, giving us a after-tax value of a dividend of 5.5. So this is the difference. Rather than having taxation twice, so here in the U.S., they have a 30% tax and then a 45% tax. In Australia, here there is a credit towards it. So franking credit is a tax credit passed on to investors by companies that have already paid corporate taxes, and there's some conditions attached. For example, they have to be residents. They have to be Australia or New Zealand-based companies or residents for tax purposes. So here we can see the calculations for this. You can pause the video and understand this. And that brings us to the end of the review. So I do hope this video was once again helpful. Once again, thanks for coming along. I am trying to document everything I learned at university. So take care and goodbye. I'll see you guys next week.